So yesterday I received a call from my brother and he said he has $5,000 to invest and he asked me should he go all in on Dogecoin or buy AMC call options. At that very moment, I started doubting if he was adopted. Well, I don't think it's his fault. A lot of people do think like him, as they think this is the easiest and quickest way to get rich. Well, I have bad news for you guys. There is no easy and quick path to getting rich. Hey everyone, it's a bald Indian here, and in this video, I'm going to walk you through what would I do if I had $5,000 to invest today. Okay, so if I had $5,000 to invest today, this is how I would do it. I'll be honest that I'm not personally good with timing the market. And by the way, I don't think anyone is. I hate that feeling of anxiety to keep on checking my portfolio to see how up or down my brokerage account is. So that's why I would personally prefer ETFs as an investment rather than stocks or options. We can use ETFs to gain exposure to different asset classes in order to make sure that we are not too exposed to one particular area of the economy. Investing in an ETF has many benefits such as low cost, low hassle, and diversification of investment. These three things combine to create a smart investment strategy that is less risky than most of the other options for growing your money. All you need to do is buy one of these funds rather than try to select individual investment by yourself. So let's start with total stock market index ETFs, where we will be able to cast a wider net with our money to be invested. A stock market index fund is an investment vehicle that contains a basket of stocks within the fund that tracks an equity index such as S&P 500, Nasdaq, Russell, and Dow Jones. So here are three of my favorite total stock market ETFs. VTI, Vanguard Total Stock Market ETF, which is currently trading at $230 and is up by almost 21% in the last year. They pay out dividend of 72 cents each quarter and they have total $285 billion assets under management. Their major holdings are in Microsoft, Apple, Amazon, Alphabet, Tesla, Facebook, Nvidia, JP Morgan, and Berkshire Hathaway. They have an expense ratio of 0.03%, which is pretty low compared to all the other ETFs that we have in the market. So the next one is VEA, Vanguard FTSE Development Market ETF, trading at $49.88 and is up by 7% through last year. They pay out dividend of 20 cents each quarter. They have $105 billion assets under management. Their major holdings are in Rogers and Spotify. They have an expense ratio of 0.05%. Next one is my personal favorite, which is VOO, Vanguard S&P 500 ETF, trading at $416 and is up by almost 23% through last year. They pay out dividend of $1.31 every quarter. They have $267 billion assets under management. Their major holdings are in Microsoft, Apple, Amazon, Tesla, Alphabet, Meta, and Nvidia. They have an expense ratio of 0.03%. Here are other ETFs which track the total stock market indexes. Feel free to pause the video and take a look at them if you would like. The next sector where I would allocate a bigger chunk of my portfolio is technology ETFs. And here are a few of my favorites. VGT, Vanguard Information Technology ETF, trading at $436 and is up by almost 25% in 2021. They pay out dividend of 89 cents every quarter. They have total $54 billion assets under management and their major holdings are in Apple, Microsoft, Nvidia, Visa, Adobe, MasterCard, Salesforce, and PayPal. They have a really good expense ratio of 0.1%. Next technology ETF is XLK, which is Technology Select Sector Spider Fund ETF, trading at $165 and is up by almost 29% in 2021. They pay out dividend of 27 cents each quarter. They have $49 billion total assets under management with major holdings in Apple, Microsoft, Nvidia, Visa, Adobe, MasterCard, Salesforce, and Cisco. They have an expense ratio of 0.12%. Next one is RYT, Invesco S&P 500 Equal Weighted Technology ETF, trading at $308 and is up by 23% in 2021. They pay out a dividend of about 31 cents every quarter. They have $2.82 billion assets under management with major holdings in Enphase, AMD, Nvidia, HP, Seagate, Qualcomm, and Teradyne. They have a slightly high expense ratio of 0.4%. Okay, so next sector I would prefer to invest in is REITs ETFs. REITs or real estate investment trust are companies that own or finance income producing real estate across a range of property sectors. Real estate has been one of the best performing investments over the last 20 years, posting the richer returns than S&P 500 index, growth stocks, value stocks, bonds, golds, and nearly every other asset class. And with REITs ETFs, you can get diversified exposure to just about every different type of REITs there is. So here are 4 REITs ETF you can take a look at. Number 1 is BBRE, JP Morgan Beta Builders MSCI US REITs ETF, which is currently trading at $100.44. They have $1.4 billion assets under management. They have an annual dividend yield of 2% with an expense ratio of 0.11%. The next one is SCHH, which is Schwab US REITs ETF, trading at $46 $47.92. They have $6.3 billion assets under management. They pay out dividend yield of around 2% annually, and they have an expense ratio of 0.07%. Next one is PSR, which is Investco Active US Real Estate ETF, trading at $108.41. They have total $130 million assets under management with a dividend yield of 2.4% annually, and they have an expense ratio of 0.35%, slightly on the higher side. Next one, my personal favorite, which is VNQ, Vanguard Real Estate ETF, which is currently trading at $106.52. They have total $43.8 billion assets under management. They pay out a dividend yield of 3% annually, and they have an expense ratio of 0.12%. So the next fair share of my $5,000 will go to the consumer staple ETF. Consumer staple ETFs invest in companies that sell essential goods and services. These companies are involved in number of sectors, including food, beverages, tobacco, and household and personal product. Basically, the item that you use on day-to-day basis. So here are two consumer staple ETFs I would recommend you to take a look at. Number one is XLP, Consumer Staples Select Sector Spider ETF, currently trading at $77 and is up by almost 16% in the last 1 year. It has $13.3 billion assets under management. They have major holdings in Procter & Gamble, Pepsi, Coca-Cola, Walmart, Costco, and Colgate. And they have a dividend yield of 2.27% paid each quarter. Next one is VDC, which is Vanguard Consumer Staple ETF, currently trading at $200 and is up by almost 17% in the last 1 year. It has total $6 billion assets under management with major holdings in Procter & Gamble, Pepsi, Coca-Cola, Walmart, Costco, and Philip Morris. And they have a dividend yield of 2.13% paid each quarter. Okay, moving on to the next sector, which is Consumer Discretionary ETF. Consumer Discretionary ETFs are comprised of companies which focus on producing non-essential consumer goods and services, like high-end apparels, entertainment, leisure items, automobile, and certain durable goods. So the number one is XLY, which is Consumer Discretionary Select Spider ETF, which is currently trading at $199.65, and the stock is almost up by 25% year to date. They have total $23.69 billion assets under management with major holdings in Amazon, Tesla, Home Depot, McDonald's, Nike, Lowe's, Starbucks, and Target. They have an expense ratio of 0.05%. The next sector I'm going to give my money to is finance. And here are two of my favorite finance ETFs. First one is XLF, Finance Select Sector Spider ETF, which is currently trading at $41 and is up by 31% in the last 1 year. It has total $44.7 billion assets under management with major holdings in Berkshire Hathaway, JP Morgan, Bank of America, Wells Fargo, Morgan Stanley, BlackRock, and Citi. They pay out yearly dividend yield of 1.55% paid each quarter. Next one is VFH, Vanguard Financial ETFs, currently trading at $100 and is up by almost 32% in the last 1 year. They have total $11 billion assets under management with major holdings in Berkshire Hathaway, JP Morgan, Bank of America, Wells Fargo, Morgan Stanley, BlackRock, and Citi. They pay out dividend yield of 1.79% paid each quarter. Okay, moving on to the next one, which is healthcare sector. As we were hit by pandemic, health was one of the outperforming sector, and these are some of the ETFs to look at. Number one is VHT, Vanguard Healthcare ETF. The stock is currently trading at $247 and is up by almost 11% last year. They have total $16.36 billion assets under management with major holdings in United Health Group, Johnson & Johnson, Pfizer, and Merck. They have expense ratio of 0.10%. Next one is XLV, which is Healthcare Select Sector Spider ETF. The stock is currently trading at $130.37 and is up by almost 16% last year. They pay out dividend of almost 30 cents each quarter. They have $31.86 billion assets under management with major holdings in United Health Group, Johnson & Johnson, Pfizer, and Merck. They have expense ratio of around 0.12%. Okay, now that we have laid out all the ETFs that we would like to invest in, this is how I would allocate my cash to each and every sector. So here is my investment pie. I would allocate 25%, the majority of my cash, to S&P 500 ETFs. And the ETF of my choice is VOO. Next will be information technology, which is 20% of my total investment. And the ETF I would choose is VGT. Next would be consumer discretionary with 20% of my portfolio. And the ETF I would invest in is XLY. The next is real estate sector with 10% of my allocation, and the ETF I would choose is VNQ. Next, I would give 10% allocation to consumer staples, and my ETF of choice would be XLP. Next is healthcare with 10% allocation. The ETF I would choose is XLV. And last is 5% allocation to the financial sector with ETF of choice XLF. So looking at my investment pie, let's see how would it perform in the last 5 years. As you can see, if I would have invested $5,000 in this portfolio in 2016, then the current balance would be $14,072, which is an 18.82% return every year, beating S&P 500 by almost 2%. I would have almost tripled my investment in just 5 years. If I would have invested $5,000 in 2011, then we would have turned this $5,000 in $27,627 by 2021. That's 6x of our initial investment of $5,000 and an average return of 17% annually. But wait, there is more. You see, investment is not like a zero-sum game. It's not like you invest lump sum amount of money and then forget about it. If you would have just invested $100 each month in addition to your $5,000 investment, and you would have a final balance of $65,305. Isn't that amazing? And that's just by committing to invest $100 each month. And those $100 would be automatically allocated to the ETFs in our investment pie. I will soon be uploading a video to walk you through step by step on how to set up this recurring investments each month. But for now, that's it for today, everyone. Hope I did provide you some value today. And if I did, please drop a like to this video and subscribe to my channel. It really helps me a lot. And please comment below, how does your investment pie look like? If you would like to learn more about ETFs, you can click on this video here. And if you would like to learn more about personal finance in general, you can click on this playlist here. And see you in the next one.